Hello and good afternoon. I welcome you to today's weekly market outlook here with Admiral Markets on Friday, the 5th of April, 2019. This is Jens Klatt speaking, and yes, we want to have a look at what to expect in the upcoming week in terms of trading opportunities, which bias we currently in, or which bias the market currently has. The DAX pushed back towards and also above 12,000 points, currently trading above that or towards in region of this level around 20 points. Let's see if we have a chance to close the week above that level. But not only the upcoming week will be of interest for us, but today is also the first Friday of the month, the day on which the non-farm payrolls report will be published from the US. Usually, going hand in hand with some elevated volatility, probably especially today. And why this is the case, this is something we want to have a look at in a few minutes. Then, before we start, as usual, we have to have a look here at the risk disclaimer. Trading with financial instruments offered by Admiral Markets carry a high level of risk, which is not suitable for all investors due to their complex nature. And before entering into a client agreement or making a transaction, please make sure that you read the terms and conditions of the service from Admiral Markets. Information's here regarding this topic on the website, admiralmarkets.com. We want to have a deeper look, as usual, here also in the ESMA decision coming into effect from August 2018 onwards already. That's now roughly said, the differentiation between retail clients and professional clients. And this differentiation here especially comes into play when talking about leverage and leverage restrictions. So retail clients now have a max leverage in Forex majors of 1 to 30. And in other currency pairs, so-called minor currency pairs, like, for example, Euro NZD or also Euro Australian dollar, two currency pairs we want to look at in the following, by the way, due to some interesting seasonalities taking place there. In one, it plays out really well so far, Euro Australian dollar. In the other, not so well. That's Euro NZD. Both are, in fact, equalizing the gains of each other. And there's also this leverage restriction then in CFDs on indices like the DAX 30, but also in gold, for example. Especially gold, we want to have a look at here in regards to the NFPs being published today. So now, where's the differentiation? There you can see it. As a professional client, you can, by the way, reclassify as or apply for being reclassified as a professional client if certain criteria are met. Then you have no such leverage restriction. What's of high interest in this regard is the negative balance protection. So usually, as a retail client, after this ESMA decision coming into effect here, you have an unlimited protection against negative balances. This is not necessarily the case for professional clients, but, and this is where Admiral Markets is very special, Admiral Markets offers up to £50,000 negative balance protection according to their policy. Further information's on the website. Respectively, feel free to reach out to the service from Admiral Markets directly. This is the face to the voice you're currently listening to. And there's then the question, sure, why Admiral Markets? So I'm located in Berlin, in Germany, and Admiral Markets is in fact a global broker, also having an office here in Berlin. And what I can say as a German and as a speaker on trade fairs or in general speaker in the webinar space here, when it comes to DAX trading, it's not unusual that Admiral Markets comes immediately into your mind. The reason for that is that there's one of the best index offerings, if not the best index offering on the DAX 30 CFD here, with the typical spread of 0.8 points during the main trading hours. There's also lots of flexibility for especially short-term traders, scalp traders, for example, offering a typical spread of 0.2 with a commission on top. Further information, feel free to reach out to Admiral directly. There is also now something of high interest for FX traders called Admiral Prime, with some very, very competitive offering in the FX business and in Euro USD. dollar JPY, and so on. So Admiral Markets here is definitely a closer look worth, and one which is also taken from many German traders. And yeah, One World Global Offers, I already mentioned it. So Admiral Markets is not only located here in Berlin, but also in several parts of the world, and also registered, regulated, authorized, for example, by the FCA, but also by the Australian Financial Service, where holds of Australian Financial Service, licensed by the AFSL, in this case in Australia, Admiral Markets Pty Limited, for example. What this could mean in terms of regulation and for your trading. Also here, feel free to check out the website for further information, or contact the service from Admiral directly. Contact, yeah, there we go. So here you have all contact details. Also the YouTube channel, I recommend to subscribe to the YouTube channel from Admiral, since all webinars, mine is not the only one, but there are several, are all uploaded there, and you have the chance to watch the recording then at your own preferred time. And now let's have a look at the agenda again. I already mentioned what we'll look at, but here's it point after point again. So the questions we want to answer are: first, what are the key economic events in the coming trading week? But not only the upcoming week, but also today with the non-farm payrolls. The question: what's the current bias in the FX, equity, and commodity markets? And then also, which trading opportunities may arise? So probably I'll start out with the bias in the markets, and then continue from there with an outlook on the non-farm payrolls. I have to say, I'm not sure how many are now here in this webinar who have already listened to what I had to say in the morning. I had the chance to hold the webinar, real-time daily trading ideas, for usually it's Dirk. I think it's Dirk's spot today, and I was asked if I could take it over since he is at Trade Fair today. So I already spoke about the non-farm payrolls today. So what I want to start with then is I want to have a look at the DAX, the current bias, and then take it from there. So indices first, and then FX, and then we go over to gold and precious metals. And there's also a very interesting pattern right now, a head shoulder formation. So let's start with the DAX, and what we can clearly see here is that we made it back above this purple line, the 200 SMA. We mentioned it several times, not only here in the webinar, but also in the written piece, which is usually published in the Traders Blog section on the website from Admiral Markets every Monday. And I have to say, it's kind of a surprise when looking at the current market environment, to be honest. This bullishness and this very strong start into the year, just in cases of the DAX especially, just remember that we still have no deal in terms of the Brexit. And to be honest, it doesn't look as if we get one. So it really looks as if on the 12th of April, next week, Friday, UK will leave the European Union without having a deal. So it will be a hard Brexit then. Sure, there's right now there are some discussions going on in the background, and probably there will be another extension if this is really capable of somehow delivering more certainty about the future, and how a deal could be struck and everything. That's in fact a question. But I have to say, the longer it takes, and I'm still on the side of those saying there will be definitely a deal. And why? Well, we know that Germany and the UK have very close trade relationships. That's the word I was looking for. Very, very close trade relationships here. So in fact, the UK is the fourth biggest trading partner of Germany. We have seen several data coming in pointing to slowdown in economic growth in Germany. So there's clearly signs of a recession at the horizon. We don't have the ECB anymore coming up with buying bonds and QE in this regards. So there's definitely some skepticism around the overall economic outlook in Germany. And if now there's also a hard Brexit, even though some deals might be struck somehow, somewhere in the future, this uncertainty alone is definitely something which is completely contrary to what you should expect for the DAX. So usually you would expect the DAX to trade significantly lower. Instead, we pushed back towards and above 12,000 points. Sure, it is certainly the shadow here of the US equity markets. When looking, for example, at the Dow Jones, you can clearly see that we are only something like, 500, 600 points below the all-time lows. And it's not only that, but over the last days, and here the bias comes into play. By the way, there was another tweet. Was it a tweet or was it an interview where US President Trump mentioned that he'll do anything he can. I'm not sure if this is seated correctly, but it was very close to that. He'll do a lot to push to help U.S. equity markets to see new all-time highs soon, and this goes hand in hand with some solid data coming in, especially from purchasing manager indices like the ISM on Monday and non-manufacturing. Manufacturing on Monday and non-manufacturing on Wednesday. Both came in very, very solid, significantly above 50. Same is true, by the way, for some Chinese manufacturing data that started already over the weekend on Sunday and continued over the week. We had also surprisingly some solid data here from the European continent. So when combining all this, this goes really hand in hand with the more and more risk on mode, which is gaining momentum and which is probably a driver higher. Nevertheless, in case of the DAX, but also when looking at the inversion of the 2-year, 10-year yield curve, especially in the US, signs of a recession are clearly forming, and it's definitely very difficult to see a fundamental reason for this sharp rise higher, other than a strong manipulation here in the market, to be honest. So in my opinion, it's still a big manipulation which is taking place, especially driven by the Trump administration, by the White House. And in this regards, let's put this in quotation marks, but only name it, it's plunge protection, which was brought into play at the end of the year 2018 from the US Treasury in München. So then building a lot of pressure, or putting a lot of pressure on the Fed, for example, who made a real U-turn in her policy. This is very important, by the way, for the NFP. We'll have a look at it later on. When you also when you track your performance as the president of the United States in terms of the performance of the equity index or equity markets in this case, then you should definitely be really careful in regards to short engagements. Nevertheless, let's put it that way. No one is bigger than the market, and I really wait for only one trigger. And by the way, a no-deal Brexit, by the way, is definitely something. We remember June 2016. Even if I see no reason not to struck a deal somehow, I didn't see the Brexit coming either. So I was sure that would be a close call, but I definitely didn't see the Brexit. And then you wake up the next morning, I think it was a Thursday, and you're trading 1,000 points lower. And the same is true in this context then when looking at the DAX. So it's not that I'm not willing to take a long engagement. So put it that way, I was, for example, long yesterday when we had this short squeeze above 12,000 points. Nevertheless, today I wasn't willing to take any long engagements anymore. This has to do with the fact that the market looks really extended on the upside right now. Plus, I'm not really sure in which direction the non-farm payrolls will drive markets into the weekly close, and also depending on how they will be published. To be honest, my favorite scenario is that equity markets won't be affected from today's NFPs at all. Nevertheless, probably especially after yesterday, one driver higher probably was the trade deal between the US and China then, where we now know that we shouldn't expect a solution or a struck trade deal here within the next week, respectively in the next 2-3 weeks, but it's more likely that there will be a final deal struck, if at all, in 4 weeks. That was something Trump mentioned yesterday in an interview, if I'm not mistaken. So, yeah, taking this into account, the driver higher here is probably diminishing. And then if you combine this with this potential bearish divergence, you can see here market pushing to new highs, but this is not confirmed by the RSI here anymore. But by the way, it's an hourly chart. Some of you might wonder, what is this blue background here? Let me just, by the way, put it here. That has to do with a seasonal pattern. Within this time span, from the 7th of March till the 3rd of April, you usually expect the DAX to rise, especially yeah, or no, not especially, but over the last, I think, 20 years, and then 15 years, so 75% of the cases, the DAX pushed higher here on average, something like 300 points or so. And it's a highly profitable window, in fact. And in fact, this drawdown here hasn't been seen because you entered the trade here, and the take profit was already hit nearly like 2 weeks later, and so you gained nearly something like 300 points. And also this year, this pattern obviously played out. So you wouldn't have stopped out here on this push lower, and then you see this rally here. So somewhere here you close the trade, and yeah, you finish the window with a nice profit in the DAX. So just to explain where this comes from, and for next week, I can already tell you the traders block section will have an article covering exactly that window and how it could have been traded here. But now let's have a look again on the technical side. This bearish divergence. So we make higher highs here, and they are not confirmed in the RSI 14 anymore. This is the first sign that the bullish momentum is obviously losing traction, and then the momentum is diminishing. The thing is, in the current market environment, you do not really expect a sharp decline, but it could also be that this divergence here is, let's call it corrected, is corrected over time, so that the market just stabilizes at an elevated level without seeing a push lower. And this is also something which goes hand in hand with what I just presented in regards to what to expect from the in terms of the performance of U.S. equity markets and from the White House. I think if there's any signs of a break lower, then there will be a clear sign and a clear stance being taken from something like the plunge protection or something, which will start to aggressively buy the market higher and push it then to the to new all-time highs in the Dow Jones, for example, to, in this case, over 27,000 points. And so with this in mind, and knowing the intermarket correlation between the DAX and Dow Jones, you shouldn't really expect the DAX to sharply decline. Sure, this could also change in case of the DAX then here dropping below 11,900 points. If this happens, a retest of 11,800 points should be expected, but you can already see we are not talking about a big decline here, but only a short-term correction. And against this region, long engagements become interesting again. And I have to say, by the way, everything above 11,250 something here, the current lows, which were marked here last week. Was it last week? Was it the week before? Not sure. The picture stays bullish above 11,250 points, and I think there's a high chance that probably instead of a push lower, there will more drift higher than pushing the DAX to 12,500 points. Nevertheless, due to this bearish divergence, you shouldn't be overly excited to see this into the weekly close. So I'm not really sure if such a significant push higher is likely, especially after the mode is so extended. The momentum is obviously losing momentum here. So yeah, that's it on the DAX. So to sum this up, what should we expect for the next week? So due to the uncertainty around the Brexit, I'm not really seeing further gains. Probably this is similar to what we've seen in June 2018. 16. So just to remind you what happened back then. So that was the window. There was 1 week of sharp gains before. That was here, in fact. So we've seen a sharper decline here from the beginning of June back then, and then there was a sharp rise higher, which pushed the DAX nearly 1,000 points on the upside. In fact, I remember this really well because I got lucky on a trade here on an intraday basis, which I nearly caught here somewhere around the lows. That was a trade on an intraday time frame, and I then saw that there was a sharp rise higher. And I started to anticipate that market participants are obviously now thinking that there will be no Brexit. And so I took the position, and I was capable of holding it then, or not, holding it, but also of rolling it into the next time frame, and then going with this push higher. Unfortunately, I didn't get filled on a small pullback here, on a further high before, and to build a bigger position then. And lucky enough, I was then taken out somewhere here in this region on the day of the Brexit. That was already overnight when the market started to come lower here. And well, then you can see here we've seen gains of 1,000 points here. And then seeing this sharp decline. And currently, this is something which I think can be seen here to some extent too. So this push higher is probably driven by the hope of a deal being struck. And if no deal is struck, and then we have the hard Brexit next week, it shouldn't be, or it definitely is an option that we see a sharp push lower of probably not even only 1,000 points, but probably even more than that. And I somehow could imagine the DAX to drop then in the following below 10,000 points, by the way. So this is definitely something to keep in mind and to be aware of, that without having such a deal, this currently is pure speculation, and one should be really careful holding long positions. But if everything plays out as currently expected, with another extension of the Brexit deadline, I think Theresa May today communicated something like that to the 30th of June or something, well then probably we don't get to see lots of volatility in the days to come, but more like a consolidation at an elevated level. Risk reward wise, it's not very attractive. Doesn't seem very attractive to go long in this region here. It would be nicer, let's say, to see a pullback against 11,200, but everything above 11,250, 11,300 can be considered bullish in the DAX. So yeah, that's it on the DAX. Now let's have a look then at the currency markets, and let's have a look here at, for example, Euro USD. Still trading around 112. There was a slight push lower. There was no real attempt to break lower, aggressively break lower. Let's see if today something like that happens. And by the way, non-farm payrolls have the potential to push the DAX. I'm sorry, not the DAX, the Euro USD here below 112, and then probably then initiate a significant run on the downside in the days to come. That has to do with something from a yield perspective I will present to you in a few minutes here. Just let's have a look here at the pure technical side first. So what is a projected target if we break below 112? Therefore, we look at the range we trade in now for quite a while, and we can see this range here between 112 to 115. In fact, and then what we just do is we duplicate this range here and put it at the bottom here, and then you have a projected target around 109 to 109.50 around. So this would be the target if the euro breaks below the ECB lows, which can be seen around 1180. Around. So the region, we tested it already over the last days, but the break lower didn't happen, probably due to some solid purchase manager indices which were published around along the Eurozone on Wednesday. So there was also some solid data coming in. Nevertheless, a significant push higher hasn't been seen. The reason for that is probably also because next week on Wednesday, by the way. So I think the main reason why the ECB rate decision takes place already next week on Wednesday has something to do with Easter. The week later, I was really surprised to see that, but it's really true. So I double checked it on the website from the ECB, and there will be a press conference, an ECB rate decision next week on Wednesday instead of usually it's Thursday. And usually, by the way, after the last rate decision, which took place on the 7th of March, then it's 6 weeks from the last event. In this case, it's only 5 weeks. So it really came as a surprise, but nevertheless, I double checked it on the website from the ECB, and it's true. So next week on Wednesday, there will be a rate decision. And this is also very interesting because we have already heard some speculation, some rumors around potential tiered interest rates. So that banks who are currently suffering under this minus 0.4% lower yield band. So the yield, or the what is this? It's the yield banks have to pay when depositing liquidity with the ECB overnight. So they have to pay for this. And they're enormously suffering under these negative rates we currently see. And now there's speculation arising that there could be an implementation of tiered rates similar to what we've seen in Japan, for example. The message from such speculation is, on the other hand, that we should expect this zero rate environment to continue for a very long time, probably also after the second half of 2020, so next year, when swap markets have seen with a majority a first rate hike from the ECB. In fact, it could really last way longer, this low or zero rate interest window we currently find ourselves in, and this tiered interest rates discussion speculation is a first sign that this could really happen. So this is one reason why the euro should be definitely viewed very carefully from a long perspective. And what we can see is, and therefore I've prepared already something on a website called Bar Chart. So it's the Commitment of Traders report, barchart.com, and then below futures, you have the Commitment of Traders report. And there you have the chance to see big speculators, for example, in the Euro FX and Euro future. It's only something like 6 to 8% of the overall market exposure in the euro. Nevertheless, the first good indication. And what you can clearly spot is that markets are currently nearly 80,000 contracts net short, so already prepared for a break lower. And there lies a chance for a short squeeze, in fact. Why? Well, first of all, because market is already heavily short positioned and it's expecting ECB, which comes out more dovish next week. And then we should also remember, if a trade deal between the US and China, for example, is struck, then there's a chance that market participants should see a chance for a deal between the US and the euro, especially Germany here, too, which could then result in market participants reducing their short exposure in the euro. Same is true for a Brexit deal. If a Brexit deal is struck, however, and whenever this may take place, or if there's only signs, that could result in a short squeeze and force market participants to reduce their short exposure, and then instead of a break lower, result in a sharper move higher. In fact, on the other hand, we have also to say 80,000. We have seen way shorter market environments, which means nothing more than there's plenty of room on the downside for further shorts being built if a break really happens. And this is also something to remember. If we break below 112, those market participants who are currently not positioned short could be forced to do exactly that, and then accelerate the momentum on the downside in this case. So it's a very close call right now. But it's not that when we're in an environment where it's a no-brainer trade to be euro short because of this already built short exposure and these events here potentially resulting in a reversal in the euro, like it's trade deal being struck between the US and China, and then seeing some kind of spillover effect on the eurozone. But all in all, from a pure fundamental perspective and also from a yield perspective, we should be really careful with long engagements, and in short, definitely short positions seem to be favored. Especially against the US dollar, the euro has a big disadvantage when looking at 10-year yields. So what you can see is we are, again, trading back above 2.5%. This is mainly due to several positive data coming in, and 10-year yield probably can be seen as bottoming out here now and now pushing higher. There's also, by the way, nevertheless, and when looking at today's non-farm payrolls, a risk to this, because now we already anticipated a better than expected probably data set, which is, by the way, very difficult to argue. In fact, especially after ADP data here last Wednesday didn't come in better than expected. So we had solid ISM data, manufacturing, non-manufacturing on Monday, on Wednesday. I already said this, and also the ISM employment component was solid, was good. We've seen compared to the month before a push higher. Nevertheless, the thing is that ADP, as you can see here on trading economics, has a positive correlation towards the non-farm payrolls. So ADP is in blue, and then there's this dotted black line, which is the non-farm payrolls. And we're going back to 2014. What you can see is there were some times, some events where one came in significantly lower or significantly higher than the other, but usually it was that there was, when there was a disappointing reading on the ADP front, that usually the other data set, the following data set, in this case the non-farm payrolls, being published after the ADP, usually following this data set. So this is definitely something to remember when looking at today's data, 129,000 against 170,000 expected. So with this in mind, chances are higher that the data set today will disappoint. Now, what's interesting, in fact, is, by the way, this is something we look at in a few seconds. So when looking at this forecast here and the economic calendar, Forex calendar from Admiral Markets, what you can see is that the forecast is 180,000. Why is this of interest? Well, obviously, this is hasn't changed much after the ADP data set. So I think this data is most likely coming from a source like Bloomberg analysts or Bloomberg, the economist Bloomberg asked for their opinion on the non-farm payrolls. But what's also interesting is there's also some interesting data then from the primary dealers. So there's here the suggestion or the guesses from big banks and their dealers here. RBC, for example, the Canadian bank is 225,000. Citi, for example, is 170, and so on and so forth. Goldman 190. What's interesting is no one really sees a significant push below 150,000, and the dealer median here is around 170, and this despite the disappointing data around the ADPs. So with this in mind, I somehow have the feeling that we probably have a good chance to get to see at least a solid reading. And why this is interesting, this can be seen when looking at this chart. So this is, by the way, a chart I found on Twitter, and it makes my life a little easier, in fact, because what's written here is exactly what I planned to show to you. And now I have this bubble here already interpreting or writing down my interpretation of the, in this case, Fed Watch tool. So you can check this out yourself. Just Google Fed Watch tool, and you will have the chance to see the likelihood of a rate hike, or the market participants and their likelihood, their expectation of a rate hike, in this case here, till December 2019. And the chart can be interpreted as follows. So here you have the current rate level. It's 225 to 250 basis points. And what you now see is that till December, more than 50%, in fact, around 55%, 54, 55%, are seeing a rate cut instead of a rate hike, which is very interesting, by the way, and this is what I mentioned at the beginning of this webinar with the U-turn of the Fed. Therefore, this is also a very interesting chart then here. This is the so-called Fed dot plot. So every dot is one Fed member. And in December, we had here the majority hiking rates from 2.25 to then 2.25 to 5.25. So the majority, and what's more of interest is here in December for 2019, most of these Fed members here saw 2, if not 3 rate hikes then in 2019. This completely changed, and we are now here at seeing no rate hike in 2019 and only one, the majority only seeing one in 2020 then in this case. So this is what I mean with U-turn. But what's more interesting in my opinion is the following. The market is obviously here expecting a rate cut in 2019 already. And this with a probability of nearly 50%. And why are the NFPs so interesting in this regards to today? Well, here the bubble refers to a miss in the NFP report, but you can also put it the other way around and see a number coming in above expectation. So not only does the NFP reading, by the way, play a big role, but also the average hourly earnings, for example. And every reading which comes in better than expected, plus average hourly earnings, surprising on the upside, similar to last month, by the way. And look at the last month reading, it was 20,000, and the US dollar didn't collapse on that. The reason was because average hourly earnings came in significant. It wasn't significant, but they came in better than expected month on month. And that was, or that is something to remember when looking also at today's data. If data comes in somewhere around 150, 160,000, one might say, okay, this is disappointing. Also, if it's only around 100,000, for example, sure. But nevertheless, if average hourly earnings come in better than expected, this speculation here might significantly switch then towards no rate cut in 2019 being expected. So currently we're at 55%, but if not, the data comes in better than expected or is interpreted from market participants in a way that they say, okay, a rate cut, even though it's only one data set, but nevertheless, it's unlikely that it will happen in 2019, could result in US dollar bullishness then into the weekly close. And then this comes now from a trading perspective, and is what's of interest here, could then result in Euro USD pushing below 112, and bring this break lower here on its way, and then probably resulting in further losses in the week to come. So that's it around the non-farm payrolls. Obviously, yields play a very important role here, and in this context, it definitely makes sense to look at so-called yield-sensitive assets, and in this case, especially gold. So, and I think this is nearly self-explaining what you can see here. It's a head-shoulder formation on a daily chart, and it may come as a surprise to many of those who listen to this format here for quite a while now, because I was not extraordinarily bullish, but I was definitely bullish, and I'm still bullish. I'm very, very positive for gold. This hasn't changed because the overall picture does not favor higher yields, but in fact it favors more QE. Respectively, it points to a recession forming on the horizon in the US, and this is usually a market environment in which gold has a very, very solid performance. And so from a pure fundamental perspective, I'm definitely bullish gold. Nevertheless, the chart tells you in which direction you should expect gold to trade. And well, what we definitely have to say is we have difficulties, bulls have difficulties to make it back above 1,300 USD. And now we are trading in a key region here on the downside, 1,275, 1,277 USD, which is of high interest, especially if it breaks, because then it makes it likely that we'll get to see a push lower, minimum down to 1,240 USD. And this is not only from a let's call it a price action perspective, but also when then looking at this development here, and is it cruciality? where the region, it's a very crucial region, in fact, because this is the neckline of this formation, this head shoulder formation. And if a break lower occurs, then also the projected target of this head shoulder formation can be found around 1,240 USD per ounce. So today's NFP report is of high interest because if such a data set comes in, which is pushing the likelihood of a rate cut of the Fed, this nearly 50-50 probability we've seen in the Fed watch tool, if this is being pushed back and market participants start to cut their expectations in regards to a rate cut into the end of the year 2019, this is something which is definitely bearish gold due to the yield sensitivity and could result then into the weekly close already with a break of this neckline here on the downside and also bring further losses on the way. So it could be, if NFPs come in better than expected, that the US dollar definitely sees some gains, while the gold price then will definitely suffer, not only from a fundamental perspective, but also from a technical perspective due to the importance of this region here. And then yield sensitivity, let's have a look also at dollar JPY. Here in this context, we can see that last week I already pointed it out. You probably remember that. I was surprised not to see the JPY gain on the developments in Turkey especially, but also in the overall uncertainty around the Brexit deal not being struck yet, while also the trade deal between the US and China is postponed. It seems as if it's postponed and postponed and postponed again, and it's somehow getting annoying. Well, let's put it that way. I'm somehow annoyed by the mentioning of the trade deal, also from Donald Trump especially, saying, well, it will probably be the biggest deal ever made, and this is something he's talking about now for 4 months, and you just wonder, why keeps he talking about that, and why is he not meeting, for example, then if it's such an important deal with like the Prime Minister Xi Jinping, for example, why didn't he meet him already in February? Why was this postponed too? So it somehow seems more and more that there won't be a trade deal being struck somehow. But let's just assume that there will, rather sooner or later, there will be such a deal, and nevertheless, there's still uncertainty, and this is usually a market environment in which you expect the JPY to drop, and it didn't happen. And it played already out on Monday then. As you can see here, we've then pushed back above 111, and it seems as if rather sooner or later there will be a test of 112. In fact, it's only 25, 30 pips away. And if NFPs come in better than expected, such a push higher, with the yield pushing higher, could also be expected then in the dollar JPY, with further gains to come. So I wouldn't really fade the momentum, especially if this current risk on market environment in which we find ourselves, if this continues. But all in all, I have to say the most interesting picture due to the technical from a technical side is definitely gold then today, and I promised it at the beginning. So let me just, even though it won't be very long, but let's just have a look at those seasonal trades again. So both are ending on the 10th of April, so next week on Wednesday. And while it looks very promising here for Euro Australian dollar, which we entered already here on the 19th of March, and which is currently moving in our direction. And hopefully, by the way, such a break lower in Euro will happen, because it will also affect the cross currencies. And if the Euro performs worst against, for example, the US dollar, why the Australian dollar can hold stable, also due to the risk on market environment we find ourselves in, then a break lower in Euro Australian dollar is likely below 157.30, and probably before next week on Wednesday, I will take profit here around 156.20 or so. Is hit. Nevertheless, unfortunately, this is currently countered by a not so positive development in another trade, Euro New Zealand dollar, that was entered already on Monday, on the 1st of April. Therefore, I'd like to come back here to the website from Admiral and just just give you an idea here. By the way, it's also very interesting for the statistic based traders. So if you're wondering what the first quarter, which was very strong for equities mean, especially US equities, have a look at what to remember. 4 things here by Ryan Detrick. Very great analysis, by the way. So I highly recommend following this guy on Twitter. If you're active on Twitter, this is a must follow, in my opinion. So 9 out of 10 times S&P was up 10% in Q1. The rest of the year, it was higher. The only exception here was, in fact, 1987. That is going back till 1950, I think. Then you had 25 of 27 times where the first 2 months of the year were green. It was that the rest of the year was also higher. 18 out of 19 times when the first 3 months, as it was this year, were higher. Then the rest of the year was also higher. And 34 out of 34 times when the S&P didn't close beneath the December lows, which didn't happen in Q1, then the full year was higher in terms of total return. So you can be really skeptic, sure, but nevertheless there are certain points to be considered, which are definitely pointing to a very solid year 2019. Surely depending on how things play out between the US and China, Brexit and all this, but even if no deal here is struck, it doesn't necessarily mean that we do not have a chance to close the year higher. And from a statistic perspective, as you can see here, in the past, it was a very good idea to be bullish then, if the first 3 months especially were as strong as they were. But now let's go back here, analytics and then the traders block, and let's have a look at the Euro NZD seasonal pattern. We published this already on Tuesday, I think, 3rd or Wednesday. Yeah, it was Wednesday. There you can find all data. I just put here. I give you the link in the chat box, and there you can see the pattern. And well, the unfortunate thing about this is that it's currently not playing out really well, since it seems as if we are breaking out on the upside here of this channel. But nevertheless, let's see. We still have 3 days to go. We certainly have to see when looking here, especially at this candle, that here our stop may be hit. Nevertheless, so far the pattern is not yet finished, and we still have 3 days to go. Plus, here the euro weakness, which probably lies ahead of us. So let's see if this scenario plays out or not. Yeah, and so that's it from my end. I hope you enjoyed this webinar, and in a few minutes, for all those who joined us a little later, it will be also available on the YouTube channel from Admiral Markets, and we'll talk again then next week, Friday the 12th of April. I definitely look forward to it. Let's see what today's NFPs deliver. If the break below 112 really happens in Euro USD, or the short squeeze comes first and then we push back towards 114. And yeah, have a nice weekend. Enjoy yourself. Talk to you again next week, and I look forward to it. Happy trading. Watch your stops. See you, and bye-bye.